Hello there, everybody. How are you doing? Welcome back to Money Conversations with Magical. And today we will be discussing about two concepts that can make you lose your savings. These two concepts are concepts that affect everybody, and especially if you're an investor and you cannot afford to ignore these two concepts. This is the concept of inflation and the concept of volatility. Let's dive in and see what they are and how to manage them without eroding your investments. These two concepts can seem very intimidating, but understanding them is the best thing you can do for yourself, and especially if you're looking at having a long-term financial health. So, what is inflation? Inflation is the rate at which the prices of goods and services rise over a period of time. It's measured in percentage. So for instance, you can say the inflation is at 5% or at 10% or 3%. So for instance, when assume, for instance, the inflation is at 10%. So it means if an item is costing 100 shillings, next year that item will be costing 110 shillings. That's inflation. And so in terms of investments, if for instance you're doing an investment that is earning you 10% per annum, and then assume the inflation rate is at 5%, in essence, your actual return is 5%. And this is why inflation sometimes is referred to as hidden tax in savings or in investments. So inflation, there are certain assets that are able to ride inflation. Assets like real estate, assets like stocks, they're able to hold firm when inflation rises. But on the other hand, cash, the value of cash is diminished over time. And unless you're investing that cash in instruments or places that are beating inflation, then your cash has no value. And hence the reason why you should be very careful when you're putting your cash in the bank. On the other side, what is volatility? Volatility is basically the fluctuations of prices in the market. It's simply the ups and downs of prices in the market. And this is measured by standard deviation. Some assets can behave very wildly. For instance, stocks, they can behave very wildly. They can swing quite in a very wild way, while other assets such as bonds are a bit more slow and steady. So you are able to understand that volatility is sometimes very sharp, but some assets are able to give you a steady kind of a behavior. So the question is then, what volatility does is that you can benefit, you can get some positive moments, or let's say you can capitalize on volatility. For instance, when the prices of shares or stocks goes down, as an investor you can capitalize on that by buying more at a lower price. So that's how one way you can look at volatility from a positive perspective. So you buy when the prices are down, and then you'll trade when the prices come up. But on the other side, volatility can lead to a lot of uncertainties and leading to market swings. So which you'd want to ask, which of the two concept is riskier? Is it inflation or is it volatility? Maybe you can comment down here on this video. Just tell me what do you think. Is inflation riskier than volatility? But from what we've seen over the years, inflation is more risky because what it does is that it eats into your money year on year, and it's very slow. It's like a slow death. You don't notice, but eventually it compounds and really affects the value of your money. On the other hand, volatility is a very short-term noise. It can be very dramatic, like you can realize the prices of certain products or certain items are changing sharply, very sharply. So it can be dramatic, but it's a very short-term noise, and especially if you are thinking long-term. So how then can we manage volatility and inflation as investors? The first thing is that you need to have a long-term view. Be in it for the long haul, because then that way you'll be able to ride volatility and inflation over time. The second thing is you need to focus on your goal. Stay aligned to your goal, because when you have a goal, you do not change your investments in between. So stay aligned to your goal. The other thing that you can do to manage inflation is that stay rational and not emotional. Because when you stay rational, you think through, you analyze the situation. But when you're thinking rationally, then you let emotions guide your decisions. So, ladies and gentlemen, it's important to understand that these two concepts are part and parcel of the investment journey. So what you need to do is create a well-diversified portfolio for your investment, stay aligned to your goals, and keep it very calm. Don't allow emotions to guide you. And that way, you'll be able to grow your wealth over time steadily. Thank you so much for listening into this video. I look forward to seeing you in the next one. Bye bye.